This morning I mentioned that two recent bankruptcies in the private credit market have people a little spooked. But what actually is the private credit market, and why does everyone on Wall Street seem so obsessed with it lately? Let's break it down. So private credit is basically when non-bank lenders, so think investment funds like Blackstone, asset managers like Goldman Sachs, or even private equity firms. It's when people like that lend money directly to companies. These loans aren't traded on the public markets, and they don't come from your traditional banks like JP Morgan. It's all negotiated privately behind closed doors, and it's far less regulated. The private credit market exploded after the 2008 financial crisis. Why, you might ask? Because after the financial crisis, tighter banking regulations were put in place that made it harder for traditional banks, like JP Morgan, to lend to smaller or riskier businesses. Private credit funds, they saw the gap and they jumped in. Fast forward to today, and the private credit market has ballooned to over $2 trillion globally, making it one of the fastest growing corners of finance. So how's it different from other markets? Compared to public debt markets like corporate bonds, private credit isn't traded on exchanges, and there's no daily price transparency. So because corporate bonds trade, every day we get updated data on what people are willing to pay for them, what the price is. Private credit doesn't trade like that, so it's hard to value the loans. Thinking about private equity, private credit is different than private equity because it's about lending money, not buying ownership stakes or equity in a company. Private credit loans are just loans, and they don't represent any actual equity. Now, when comparing private credit to true bank loans, like with a JP Morgan or Bank of America, private credit deals tend to be more flexible, they have higher interest rates, and are riskier because they're often made to companies that can't easily access traditional loans from traditional banks. Loans from banks are also more highly regulated than private credit. In short, private credit has become the go-to place for investors that are hunting for yield and for borrowers who need customized financing or who can't easily access a more traditional form of financing. It's been a massive shift, reshaping how credit flows through our economy. So next time you hear someone mention private credit, now you know what it is.